Hello and welcome back to the Analyst channel. Today we'd like to talk about Chargepoint. Chargepoint provides electric charging infrastructure that's connected to software in the cloud where you can locate, reserve, and transact on your phone. It provides chargers for commercial, residential, fast charging stations, and urban. To date, it has more than 17,000 stations and 5,000 customers. It's quietly experienced phenomenal growth over the last few years. It intends to expand globally with high growth markets such as Europe and Asia Pacific. It has growth potential in fleet and residential areas. Recently, it had an infusion of growth capital from a SPAC merger with Switchback Energy Acquisition Corp. Chargepoint has an impressive customer list, including employers who provide charging stations to their employees, such as Netflix, 3M, Dell, eBay, GM, and Google. It has customers in retail and hospitality, including Marriott, Sheraton, Kohl's, Safeway, and Target. It also has municipal, state, and federal clients, including cities such as San Francisco, San Jose, New York, Boston, and Orlando. Government customers include the U.S. Department of Treasury, Transportation, and Public Works. What we like about Chargepoint is that it is positioned well in the electric vehicle charging market. It is tied directly to the growth of EV vehicles in that market. Electric vehicle sales are forecast to grow globally at an annual rate of 27% from 2021 to 2030. This is due to a number of factors, including an increase in entrance into the EV sales market, increased competition, high growth markets like Europe and Asia Pacific maturing and taking off. There has also been growth in both the passenger fleet and commercial sectors. Lastly, the move to the green economy with government incentives, policy changes, and increased social awareness for green initiatives will lead to the continued growth of electric vehicle sales. Interesting, what is holding back growth in electric vehicle sales? Supply of materials, including battery materials and other components, and to Chargepoint's benefit, a shortage of infrastructure for charging that is standardized. You can see in the charts from Deloitte and Bloomberg that there will be significant growth in the electrical vehicle market from now till 2030 and again to 2050. You can see off this chart from Chargepoint's own website that they recognize their growth has been directly tied and proportional to the growth in electric vehicle sales. So what do we like about Chargepoint? Why do we hold this stock, and why do we think it has some significant upside over the next couple of years? The pros to the company include it already having a significant market share and a head start in a fast-growing sector. It is well established. It is also tied directly to the growth of the electrical vehicle market, which everyone knows is bound to grow over the next few years. It is expanding globally with an already good established base in the United States, but moving into high growth markets such as Europe and Asia Pacific. In the government supporting the electrical vehicle charging market with direct incentives. It has untapped markets where it will see continued growth, such as fleet markets and residential. Why are we cautious about this stock? It has experienced a lot of short-term price volatility, partially due to the overall volatile stock market conditions of the last 2 months. It has already seen share price growth from its merger with a SPAC. It is also tied to the electrical vehicle market, which in the short term has experienced fluctuations. Chargepoint is not really an alpha stock breaking out on its own yet. Another con is that its technology could be commercialized and copied by competitors, although we feel it is already a market leader and is well established. Lastly, it is not yet profitable, although this is acceptable because it is an early stage high growth company. From a revenue growth standpoint, Chargepoint looks very promising. In the first quarter of fiscal year 22, Chargepoint posted revenues of $40.5 million, which was up 24% year over year. For second quarter, the company expects revenues to range between $46 and $51 million. For full year 22, ChargePoint has forecast revenues of $195 to $205 million. From sales and through its merger with the SPAC company, it is $600 million of cash on the balance sheet to support growth. This is a very healthy position. There are some concerns as the company incurred a loss of 84 cents a share in Q1. This is mostly due to investment in growth of charging stations and accounting entries due to shareholder liabilities. Overall, with its high growth trajectory, we are cautiously okay with the financial position. Why are we adding to our position on ChargePoint? Due to a recent market pullback last week, it closed at $27.90 on July 9th. It had had recent highs as high as $35. Although we think the market may pull back further, no one can know, we think there is a good entry point between $25 and $28. Analyst forecasts see this stock going to $35 to $39. At $39, we would see a 39% return. We believe this is doable in the short term, as in a 1 to 2 year period. In the long term, we could see ChargePoint exceeding the $46 high forecast, which would be a return of 64%. We could see this stock going between $46 and $60 in the long term. Due to recent market conditions at a macro level, the chart is difficult to read. The last 2 months, the stock market has had several downward adjustments followed by an immediate return. However, looking at the ChargePoint chart, the 50 and 100-day and 200-day MACD signals a buy. The short-term or 20-day MACD signals a sell, mostly due to the market volatility I've already mentioned. This is not currently an alpha stock. It won't be breaking out on its own. It's influenced by the electric vehicle sector and also overall market conditions. Due to recent retracement in market conditions, I would consider buying the dip. There will be critical mass at one point where ChargePoint expands globally, moves into new markets, the electric vehicle market grows, and it can likely become an alpha stock and break out on its own. The RSI is literally right in the middle, signaling a hold. You could wait for a further pullback down towards $25 or take a long-term position right now. Support is at $27.05 with a further pullback, second support level $26.40. Resistance is between $28.59 and $29.25. We would predict if it breaks through this resistance, it could regain recent highs of $35. Thank you for listening to this video. Just a reminder that we are not financial advisors or financial planners. We are providing this as information. Please do your own due diligence and let us know what you think by commenting below. Also, please support the channel by hitting the like button and subscribing. Thank you.